So I want you to get super familiar with stock screening. Stock screening is sort of the first step that you will use to test out an idea. Later, you'll use more advanced tools to really flesh it out. But stock screening should be one of the first tools that you get accustomed with. So let's go ahead and look at the stock screen. Now in the tabs we have About tab. That's just a simple description and a chart. We have the Settings tab. There's a few features here that we can toggle. Change our benchmark. We can make it long, short, hedged. This is the universe or the pool of stocks that we're going to be screening. Don't change anything there. We'll get to that later. Rules, which you've already seen. These are the 16 simple rules that I've put in, and you're only supposed to turn one on at a time. We'll come back to that. Hedge, we're not going to use that now. The backtest tab, this is where you're going to want to run the backtest. We'll click that button in a minute. Rolling, let's forget about it. We want to focus on settings later, rules, and backtest. Let's go to the rules section. So the very first line in the rules section states that we want stocks that have a market cap of less than 500 million and that have dollar volume going through them of at least $50,000 a day. We want to keep this rule on at all times. It's our liquidity filter of focusing on microcap, small cap stocks, but at least there is some money going through them. They're not completely illiquid. Now we need to turn on a second rule. This one here says the current fiscal year earnings estimate is greater than what it was 4 weeks ago. So analysts have upgraded the earnings forecast. Very simple. Now if you click this tab here, this button here that says totals, it'll just show you how many stocks are passing through today. So our universe of stocks that we selected up here, the United States stock universe, 6,631. The ones that passed our liquidity filter and that were also under 500 million, 2,398 stocks. The ones that passed our analyst upgrade rule, 341 stocks. That just gives us an idea of how many are passing as of today. But what we want to do is backtest this idea. So click the backtest tab, go over and click run backtest. But just before you do, notice the period. The period, we're running it, I'll just click the max button, from January 1999 until today. That's the full extent of the history that Portfolio 123 is giving us to test in. Rebalance frequency, we can select every day, once a year, but let's just pick every 4 weeks for now. Okay, we'll leave that and click run backtest. Give it a few seconds. And voila, this is our backtest. So here under screen, the red line, this is the performance of that rule. 17% annualized returns, the drawdown, Sharpe ratio, and you can pretty much forget the rest of these stats. Okay, I'm going to center this. There we go. Now in this chart, if you look at the second turnover box here, it's showing us that this is an incredibly high turnover rule. Probably 70 to 80% of the portfolio is being traded every 4 weeks. And that makes sense because we're only looking at the last 4 weeks of analyst upgrades. So every 4 weeks, it's basically going to change. An analyst isn't going to upgrade a stock continually every 4 weeks going forward. It usually just happens once and then it slips off the rule. So now let's go back to rules and we're going to click the little circle beside it, turn it red. That rule is off. We're going to turn another one on. Let's just go down the list. The yield is greater than 3%, the dividend yield, and our short interest is less than 2%. Okay, let's see how that works as a strategy. Processing done. All right, so that's fairly decent, but the one thing to note is that this is a low turnover strategy. Maybe 12% turnover every 4 weeks. So this is a reasonable rule to start making something better from. We don't want super high turnover with small stocks that are fairly illiquid. We'll just get eaten alive in transaction fees. In the box below that, number of positions, it just shows you throughout time how many positions are being held in the portfolio. Okay, so now let's just pick another rule. Let's pick the dividend yield is greater than 3% and the payout ratio is less than 50%. High yield, low payout. Let's try that concept. This seems like a very strong idea. We can see that it has generated 20%, over 20% annual returns since 1999. The turnover is getting a little bit higher, maybe around 15%, still not too bad. And the number of positions over time, we've got lots of stocks to choose from. Right now we've got 78 stocks that we can choose from. Historically it looks somewhere around 50, 45. So just go ahead. I want you to play with every single rule on this. Keep the top one on and just toggle them one by one and go through and just get a feel for how it works. When you're done that, what I'd like you to do, go into the backtest tab and change some of these settings. Go ahead, click the calendar, say I want to only screen in the last 10 years. Click Run Backtest. So this strategy over the last 10 years hasn't been outperforming. Then we want to change the frequency. Say, well, what happens if every 13 weeks I rebalance? Generally speaking, the longer between the rebalance periods, the worse performance you're going to get, but not always. But just play around to see how that affects it. Let's say every week we're going to rebalance this portfolio. Now it takes a little bit longer. Okay, if we rebalance every week and the turnover is quite low, maybe around 5%, that's not bad. And it helps out the performance quite a bit to keep current. Now slippage. In this box, if you want to estimate friction costs, because whenever you're trading smaller stocks, it's going to really eat away at your capital. So we want to just estimate some slippage. Let's say 0.5% per transaction. And also the benchmark, let's click on that and change it to something a little bit more realistic. The S&P 500 is not what we want to be using here. Where are we? Specialty indexes. How come I can't find it? Here we go. Well, no, the S&P Small Cap 600. I think I want we can have the Russell 2000, the Russell Micro. Let's try that. Okay, so we can see actually this strategy has outperformed the Russell Microcap benchmark, and the slippage gives us a little better indication of what it would be like if we traded this system in real life. Now, generally speaking, I'm not going to use slippage at this point. You might just want to take it out. And the reason why is that this isn't the tool that we're going to use to build real life portfolios to run. This is just to give us an idea, a rough concept of, does the strategy work? Does it make sense? We run it through a few tests and then we move on to the simulation tools. You can put it in if you want, but I generally leave slippage out at this point. So that's your first lesson. Go ahead, go to rules, go through each one of these, turning them off and on, and if you want, go ahead and put 2 of them on. See what happens. It might be overly restrictive. You might get a funny answer because they don't mesh well together. For example, yield greater than 3%, payout ratio less than 50, and we'll also turn on this rule, which will say that short interest has to be below 2%. Now I just want to hit the totals button to see, yes, it goes down to 68 stocks as of today that go through. Let's hit run back test to see if this works well in the back test. This seems like a very solid idea. So this is giving us something more to work with right there. Just those two simple rules put together. Now, of course, you can go back to back test. You can say, I want to test this idea just over the last 5 years. I only want to trade every 13 weeks. I want to put in maybe 1% slippage. Doesn't work well at all with those parameters. Let's change it to once every 4 weeks. I'm just going to remove slippage because honestly, there's ways that we can lower our turnover in other tools. Let's just not use it. Okay, so over the last 5 years, this is actually a much better system than the Russell benchmark. Let's look at since 1999. Again, rebalancing every 4 weeks. This has been a pretty solid system since 1999, although the turnover is getting up there a little bit. So go ahead, play around, get familiar with it. You can even change the stock universe if you want. Go ahead and do that under the settings tab. You can change it to United States, including ADRs and dual listed stocks, or all listed stocks, or maybe you want the Russell 3000. Go ahead, just play around a little bit and get familiar with these tools and just have some fun with it.